I am an attorney, and so I tend to fall into that. So if I say something that you don't understand, or I'm using words that are exclusive to the legal profession, please call me out. I'm happy to explain. I'm happy to answer questions as we go along, so don't worry about that. Hopefully this will be of interest to you. So what I'm talking about tonight is, as Jason said, the impact that Prop 13 and all of its progeny has on estate planning. And we're not going to go into a tremendous amount of detail because you aren't here to get continuing education credits. You're just here to learn some things. So where we have to start when we're talking about Prop 13 and all of its progeny, and I'll explain what I mean by that in a minute, is actually with Prop 13. But backing up, the law in California is that whenever there is a change in ownership of property, and I'm talking about real estate, not personal property, real estate, whenever there's a change in ownership, the real estate gets reassessed. And it is the assessed value that our property taxes are based upon. So anytime there's a change in ownership, we get a reassessment. And what a change in ownership means is where the planning opportunities come in. Because even though you think you understand what change in ownership means, you are going to discover that change in ownership is something very unique in this world, and we don't always know what a change in ownership means. We have to read the law. Okay, so just keep that in mind. Anytime there's a change in ownership, and that's an important term, it's what we call a term of art. It means something very specific. When there's a change in ownership, the property gets reassessed. So the first thing about Prop 13 we have to understand is exactly what is a change in ownership, because I'm telling you that's an important term. Prop 13, a lot of people in this room are on the young side. You have always had Prop 13 in your lives. It was a California constitutional amendment that was passed in 1978. And what it basically did is it said that two things. Property can only be, the property taxes have to be 1% of the assessed value and no more than that, 1%. The other thing is property taxes cannot be increased by more than 2% per year. So those are the two pieces of Prop 13. The primary one that we are focused on in estate planning is that 2% increase every year. That's a really nice thing if you own real estate for a long time and it actually increases in value, but the assessed value that the assessor uses is going up very slowly. It's not matching the fair market value. The assessed value is going up only 2% a year at the most. If inflation is less than that, it goes up less than that. So that's the fundamental concept of Prop 13. Oh boy, okay. So change in ownership, we find the definition of that in the Revenue and Taxation Code, and you can see it means the transfer of a present interest. So present interest, that's important. If you transfer your real estate, let's say, into a trust for, you're doing estate planning, and maybe some of you in the room have trusts. Does anybody have a trust? Yeah, okay. So part of your planning is you put your real property into your trust. Now your trust owns it. And your children, let's say, are the future beneficiaries of this trust. But they are not the present beneficiaries of this trust. So when you transfer your real estate into your own estate planning trust, you really are transferring it from yourself to yourself, even though in the future your children have an interest in this trust, but it's not a present interest. So for that reason, among others, that transfer is not going to cause a reassessment because you're just transferring it from yourself to yourself. It's not a real transfer. Okay, so that's what you need to know about Section 60. Okay, so what is important to understand when we're talking about this estate planning and Prop 13 is that not every transfer of real estate is what we call a change in ownership. Remember, only a change in ownership results in reassessment, but not every transfer is a change in ownership. So one example when a transfer is not a change in ownership is when you transfer the real property to an entity. like a corporation or an LLC or a limited partnership. So you own the real estate, and then you go to an attorney and you set up a corporation, and then you sign a deed transferring the property into your corporation, and now the corporation owns it. That is not a transfer as long as the ownership structure on both sides of the deal is the same. In other words, the owners of the real estate before it got transferred in are the owners of the corporation in the same percentages. So let's say it's husband and wife, 50-50 owners of the real estate. They transfer it into a corporation of which they both own 50%. That is not considered a change in ownership, although it clearly is a transfer. It used to be owned by husband and wife, now it's owned by a company. So not a change in ownership, yes, a transfer, not a change in ownership, no reassessment. Okay, so you're starting to see kind of the logic of it. That term, change in ownership, very important. Okay, another exception where a transfer that clearly is a transfer, we all would agree it's a transfer, but is not a change in ownership, is transfers between spouses. So California Revenue and Taxation Code Section 63 says there is an unlimited spousal transfer. You can transfer any real estate you want in California to your spouse, and it's not a change in ownership, although it clearly is a transfer, so there's not going to be a reassessment. Any real estate transfer between spouses is not a change in ownership, although it is clearly a transfer. Yeah. Okay, and the important point about the interspousal exception is that it's unlimited. Again, any property, no matter how much it's worth, no matter how many different times you do this, how many different properties, interspousal is unlimited. So another example, and this is probably the one that we deal with most in my estate planning practice, because I'm writing wills and trusts and helping families with their estate plans, is the transfer between parent and child. And that's under Revenue and Taxation Code 63.1. That was enacted as Prop 58 several years after Prop 13. This was in 1986. Prop 13 was in 1978. And it became, I guess, apparent that they needed to have yet another kind of loophole to make Prop 13 really be robust. So they added the parent-child exclusion. So what that means is that a transfer between a parent and a child, which clearly is a transfer, you know, the parent used to own it and now the child owns it, that's a transfer, that is not considered a change in ownership and therefore no reassessment. And it works going the other way. That's not very common. It's not very common that children are giving real estate to the parents, or children are dying and the parents are inheriting real estate. That just doesn't naturally occur very often, but it does work both ways. So back to the parent-child exclusion, Section 63.1. As I said, this is limited. It's not unlimited like the interspousal. It's limited. So it applies to the personal residence of any value, personal residence, and it applies to up to $1 million of other property. And that can be any kind of property. It could be commercial, it could be residential, it could be, you know, multi-unit, that kind of thing, up to $1 million. And it could be multiple properties that together add up to $1 million. And this is the really great part. That $1 million is based on what they call in the statute the full cash value. You see I have it in quotation marks, full cash value. That means that's an important term. It doesn't mean what you think it means. Full cash value is the assessed value, the current assessed value.
Prop 13 assessed value.
Right. So when the property gets transferred from parent to child, you know, on the day it gets transferred, it has an assessed value. They tell you your assessed value every year. You get a notification, what's your assessed value. That is the number that we use to add up to $1 million. So an example in my practice, I'm working right now with a married couple. They own like a whole block, a whole residential block on Alameda. You know, there's maybe 6 single-family houses and a couple of duplexes. And altogether, it's worth about $10 million, fair market value. But when we get out all the assessed values, we look at the statements, it's probably going to be about $2 million of assessed value for all of their property. So when we're doing estate planning, that's a great thing for the parents to be able to leave all of that property to their children without getting a reassessment. Okay? So each person, each grantor, person who's giving the property or in leaving the property in their will, each person gets this. They get to leave a personal residence and they get to leave up to $1 million of other property. So in my family's case, we have a mother and a father, and on this city block that they have in Alameda, there's their personal residence that they live in right now, and that one is the most valuable one. It's about $2 million fair market value. And the other properties add up to about $8 million fair market value. So between the two of them, they got the one personal residence, and they each can leave another $1 million in full cash value.
You say each?
Yes, yes.
Wow, that's
And
big.
yeah, it is. For this family, they're going to be able to leave $10 million worth of real estate, no reassessment. And the other thing is that each parent can leave a personal residence too. So most of the time, spouses don't die on the same day. You know, one spouse will die and the other one will live for a few more years. So in theory, one estate planning technique would be, after the first spouse dies, the surviving spouse moves into one of the other properties and makes that their personal residence. And now you can leave that any value, no reassessment. It's just another kind of planning technique. Okay. So the thing about transferring from parent to child, we're still focused on the parent-child exclusion here. And I'm sorry, that's a little small. Hopefully you can see it. But I'll talk you through it. Here we're talking about the parents leaving property to their children. So that box represents the parents' trust. And the parents' trust owns property number 1 with full cash value, assessed value of $1 million. Property number 2, same thing, full cash value of $1 million, and the personal residence. And I'm showing you how all of this is one parent. We have one parent here, though. In my scenario, I was telling you about the family in Alameda, there were 2 parents involved. Here we have only one parent. So what's going to happen is property number 1 can go to the kids with no reassessment because it's got full cash value of $1 million. Personal residence can go with no reassessment, but property number 2 is another $1 million property that is going to get reassessed because we can only protect personal residence plus $1 million because we only have one parent in this scenario, okay? Now, another little wrinkle on this is for the parent-child exclusion to apply, the transfer has to be from parent to child. So I've got an example of here where we have the parent's trust again, and it owns the personal residence, which we can leave to our children without any reassessment. Plus, it has $600,000 in cash, okay? And the personal residence is worth $300,000. So we've got a $900,000 estate, and we have 3 children. So the trust says I leave my estate equally to my 3 children. All right, that's great because we have $900,000. That means each kid is going to get a $300,000 inheritance. So how are we going to do this? Well, we could have child number 1 gets the residence. That's his $300,000. And child number 2 and child number 3 each get $300,000 in cash. So that's great. That's a parent-to-child transfer on the residence. No reassessment. However, hopefully my next scenario shows this is not going to work. We got the residence $300,000 again, but we only have $300,000 in cash, and we have 3 kids. So we have 600. That means each kid is going to get a $200,000 inheritance, right? 600 divided by 3. But the house is worth 300. So how is that going to work? So the options are we have the $300,000 house owned by more than one child, because any given child is only going to get a $200,000 inheritance. So we could have the house owned by multiple children. They could share the house. Or, as is usually the case, they don't want to share the house. You know, most of my clients do not want to be co-landlords with their siblings. That's just not a happy family. So they usually will say to me, this child wants to own the house, we will take the cash. But the math is not going to work here. So what's going to happen is child number 1 will get the house, 300. Child number 2 will get 100. Child number 3 will get 100. And child number 2 and child number 3 each get a promissory note from child number 1.
So is there another way to add to that estate plan? I'm not sure if the estate issue is the insurance. Or do child number 1 refi, pull out cash, and get good enough credit to pay off child number 2, number 3?
Okay, so the perfect solution is the parents do something like Jason suggested. They buy a little bit of life insurance to increase the value of the estate, so it's all going to work out for the kids. So if these parents just had $300,000 more in life insurance, it would all work out. It would be like the first slide I showed you. If instead we do what you suggested, which is give the residence to child number 1, have him refinance and pay off the other 2, that is considered a purchase sibling to sibling. So child number 1 is actually, in essence, buying part of the house from child number 2 and child number 3. So that's not a parent-to-child transfer. That's a sibling-to-sibling transfer. And what that means, I'll get you in a minute. What that means is whatever portion transferred from sibling to sibling, that is a change in ownership because it doesn't fall under the parent-child exclusion. It will get reassessed.
And in that kind of case, the reassessment is prorated?
Yes. In the parent-child situation, the reassessment would only be as to the part that is not the parent-child transfer. So this last kind of section about things that are and aren't changes in ownership, this is kind of the most complicated part. So remember I said before, when you transfer real estate into an entity or out of an entity, as long as the ownership on both sides of the transaction is exactly the same, that's not a change in ownership. Okay, so what happens if we have an entity that already owns the real estate, a corporation, and the shares of the corporation change ownership? All right, so now we have a situation where the real estate is not being transferred. So let's say it's Apple. Apple owns this big campus in Cupertino, right? And if you buy stock in Apple, you own part of that entity. And then if you sell your stock in Apple to some other person, now that stock has changed ownership, but that Cupertino campus hasn't changed ownership. It's still owned by Apple. And that makes sense. It's not a transfer of the real estate. So there's not going to be a reassessment when you sell your stock in Apple. However, there are certain circumstances where when the ownership of the entity changes, for this Prop 13 purposes, the assessor's office is going to call that a change in ownership, and they will be entitled to reassess the property. And there are 2 cases where that can happen. And this is something that we encounter a lot in estate planning when we're working with LLCs, because and family limited partnerships, we use these in estate planning for a lot of different reasons. So a transfer of the entity, of the stock, or the LLC interest, or the partnership interest, is not a change in ownership of the real estate, except in these 2 cases. The first one is when a single person or entity now has acquired a majority interest in the entity. And I've got I think I have a diagram to kind of help illustrate that. So let's say we're starting here on the left-hand side of the page. The parent owns 100% of our corporation. I call it X corporation. So parent owns 100%. And parent decides, I'm going to give my children some of this stock that I own. This is my corporation. I own 100% of it. I'm going to give each of my children 20% and leave myself with 60%. So transfer of an interest in an entity is not a change in ownership. Here, we are not falling under the exception I just told you, which is if some individual acquires a majority interest. The parent has always had a majority interest. As a result of this transfer, each of the children have acquired only 20%. That's not a majority interest. So this transfer of stock is not a change in ownership of the real estate in this situation. Now, in this situation, it's the same thing. We started with a parent owning the business 100%, and he really likes child number one a lot more than child number two. He gives child number one 60% of the corporation, child number two 20%, leaving him with 20%. So now child number one has acquired a majority of X Corp. So even though the property hasn't been transferred at all, it's still owned by X Corp, the assessor's office is going to say that is a change in ownership, and they're going to reassess the property because somebody has acquired a majority interest. So this is a really important rule to be aware of if you're working with entities in your real estate investments. You always want to be mindful of this. People don't think about it because no deeds are ever signed, but it's very important to keep this in mind. Okay, the other exception. Remember, we're starting from the premise that transferring the stock is not a change, is not a transfer, it's not a change in ownership, except when we transferred the property in to the corporation and we used that original exception I told you where the transaction with the ownership on both sides of the transaction is the same, that's not a change in ownership. If we use that exception to get the property into the entity in the first place, if more than 50% of the original owners get rid of their interest, even though the property hasn't changed hands, it's still owned by the corporation, that's going to be considered a reassessment. And I think I have a diagram that might help explain that. So in this case, the parent owned the real estate and set up a corporation, X corporation, and he transferred the real estate into X corporation. That wasn't a change in ownership because it was 100% parent on this side of the transaction, 100% parent on this side of the transaction. Now the parent is going to give 20%, 20%, 20% to his three children. So more than 50% of the original ownership has changed hands. That is going to be a reassessment too. And the difference here when we're talking about these entities and reassessing, remember when I talked about the parent-child exclusion and the reassessment would only be as to the portion that did not go parent to child. It would only be as to the sibling-to-sibling portion, and the rest of it wouldn't get reassessed. When we have a problem like this, the entire property gets reassessed. We don't get to carve out little percentages. The entire property gets reassessed under these sections. Okay. The last exception I'm going to talk about is joint tenancies. There are certain situations when we're dealing with joint tenancies that are not considered changes in ownership, even though they clearly are transfers. And I'm not going to go into a lot of detail because this is you can really get bogged down in here. And to be honest, I don't deal with joint tenancies very often. It's a disfavored method of ownership for most purposes. So it's not something that I personally encounter very often in my practice.
Why is it disfavored?
Well, the tax result is not usually as good on a transfer on death because you don't, when you have a joint tenancy, you only get a half step up in basis. Like a lot of times husband and wife used to own property as joint tenants, because that means that if one of them dies, the other one now automatically owns the whole thing. But for income tax purposes, that's not as good a result, because you only get the step up of the half of that was owned by the deceased spouse.
Gotcha.
And we prefer that spouses own their property as community property with right of survivorship. It has the same effect. When one spouse dies, the other one owns the whole thing, but they get a step up in the whole thing gets a new tax basis. Now I'm talking about income tax, not property tax. And so that's usually preferable. So that's one reason we don't like to. The most common scenario is husband and wife, and we don't like to use joint tenancy. But you just need to know that there's some planning opportunities with joint tenancies that I don't usually work with, but they exist. Okay, so the last couple of things I want to talk about are what you have to do to make sure you're in compliance and that you protect all of these exclusions that I just told you about. So every time a deed gets recorded, transferring real estate, we have to submit a form that goes to the assessor's office. It's called Preliminary Change in Ownership Report every time. And on that form, we're telling the assessor the reason why he shouldn't reassess the property. You want to make it really easy. You want to make it really clear. I think I fall under, section 63.1. So you submit that. Anytime somebody who owns real estate dies, you submit a change of ownership statement, death of real property owner, because the assessor's office is going to start looking around. Okay, somebody died. What's happening to this property now that somebody died? You are required to notify them. And there's a special form for that. If you are participating in a transfer that will be subject to the parent-child exclusion, there's a special form for you to report that. It's called a claim for reassessment exclusion for transfer between parent and child. You have 3 years from the date of the transfer to submit that to the assessor's office. If you don't do it, you lose out on that exclusion, and so you want to make sure you do that. You want to do it earlier rather than later, because even though you have 3 years, if the assessor thinks that a transfer has occurred and you don't submit that form, they may send out a notice of reassessment, and then you get a new tax bill, and you have to pay the tax bill. You can go back and fight with them about the parent-child exclusion, but in the meantime, you have to pay the tax bill. So it's much better to be ahead of that curve than behind and trying to get your money back from the tax assessor. And the same thing, there's another form very similar for the grandchild exclusion. Same thing, 3 years, but get it in earlier than that, because they're probably not going to wait 3 years to send you a new tax bill. So you just want to head that off and let them know. Okay, that's all I have, but I'm happy to answer questions if you didn't get a chance. And I'll stay and answer private questions if you don't want to ask in front of the whole group. Yeah.